Welcome to my channel. I'm going to show you step by step how to value a stock to determine whether it's a buy or a sell. At the end of the video, we're going to look at the financial ratios of the company, leave a comment, and I'll be sure to answer. The company we're going to look at is Installed Building Products. They started in 1977 and they're an installation contractor with over 7,000 employees at more than 175 locations throughout the United States. Let's get started with the model. This company has a market cap of $2.7 billion. So it's a mid-cap company. Let's see what they're trading at, $88.98 a share. And the way you value a company is you estimate the future free cash flows and then discount that back to today's dollars. And that's what we're doing in this video. Now I'm going to pull their actual free cash flows. And free cash flow is cash flow from operations minus capital expenditures. We also need the net income, which is a profit and loss on the income statement, and also the revenue, which are the sales on the income statement. We just want to take a quick look at the numbers to make sure they look okay. Free cash flow and net income seems to be consistent year to year and positive, and their revenue is going up quite a bit. It almost doubled from 2016 to 2019, so pretty good growth. Let's look at a capital structure. They pay $28 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to liabilities section. Current debt of $24 million. And then long-term debt of $545 million. And since interest payments are tax deductible, let's get their effective tax rate. Income before tax of $92 million. Income tax of $24 million. Effective tax rate is 26%, so the cost of debt is 3.6%. Let's get the beta so we can figure out the cost of equity. They have a fairly high beta, 1.81, so the stock moves a little less than 2 times the market. So it's a bit volatile. Let's go back to the balance sheet, get their current assets. We need to calculate the current ratio later. And current assets of $581 million. And let's see what that is. $215 million of cash, $244 million of net receivables. This is how much money other companies owe this company. $74 million of inventory, $46 million of other. Current liabilities of $214 million. Let's see what that is. $24 million of current debt, $98 million of accounts payable. This is how much money this company owes other companies, and $39 million of other. Stockholders' equity is the value of the company according to the balance sheet. That's $250 million. Stockholders' equity is total assets minus total liabilities. $329,000 of common stock, $173 million of retained earnings. Retained earnings is the prior net incomes not paid out as dividends. And negative $7 million of accumulated other comprehensive income. We also need the operating income to calculate the interest coverage ratio later. That's $121 million. Let's look at the capital structure. 69% debt, cost of debt is 3.6%. 31% equity, cost of equity is 16.2%. And the WACC is 7.5%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $1 billion. We discounted those numbers back to today using the weighted average cost of capital. That's here in green. We get a value of the company of $1.3 billion. We divide that by 30 million shares, and we get a calculated stock price of $43. They're trading at $89, so they're trading at a 109% premium. It's a sell according to the model. Simply Wall Street has them at $93 a share, so quite a bit different than I have them. So I'm just using their prior financial information and forecasting that into the future. Let's see where the stock has been trading. So it's at its all-time high right now, and it looks like it was trading about $35, even lower than my calculated stock price a couple months ago. But the stock price has been driven up with coronavirus because people probably need a lot of help at home because they're staying at home and they need to get things fixed. Let's look at the financial ratios. Not a good PE, a really good price to sales, and a weak price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 39.6. So investors are paying $40 for $1 of earnings. Price to sales ratio, stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 1.8. So investors are paying $1.80 for $1 of revenue. It's a great ratio. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 10.8. So investors are paying about $11 for $1 book value. Good current ratio, good ROE, and good interest coverage ratio. Current ratio is current assets over current liabilities, so they can easily cover their current debts and payables. ROE is net income over equity. I like to see above 20%, they're at 27%, so they do provide a good value to the equity holders. Interest coverage ratio is EBIT over interest expense. I like to see above 2, they're at 4.3, so they can easily cover their interest payments. The best way to look at ratios is to compare them to other companies. I've done videos on Cornerstone and Masco, both in the same industry as installed building products. And IBP is here in the middle, and if they have a number in red, they're worse than the average. If they're in green, they're better than the average. They have the best current ratio, ROE, and the lowest in debt of the three companies. In terms of market cap, they're in the middle. The ratios look better than the other two companies because Cornerstone has negative PE, which means they have negative earnings. Masco has negative price to book, so that means they have negative equity, so their balance sheet is worth nothing. Let me know what you think of the video. Leave a comment. I'll be sure to answer. Thanks for watching.